So you're going to see gap supply or demand zones very often. They're very easy to spot, and a lot of them form because you get a lot of gap ups, gap downs with certain stocks, whether it be a catalyst, news, earnings. There's going to be a lot of different gap ups on the stocks that we do trade on a daily basis. Some may not gap up, some may gap up. But I consider gap ups and gap downs that form supply or demand zones to be less quality type of trades, and I don't really focus on them too often. I do mark them on my charts. I do pay attention to them, but it's not really something that I really care for. They're not the highest quality of trades. I've seen gaps really get destroyed sometimes, and I'm going to explain why they do actually form. So why gaps are a thing? It's basically when a stock opens much higher than where we closed at, or where we open much lower than where we closed at the previous day. And it's very easy to manipulate a gap up or down since we have very low liquidity overnight. It's very easy for the stock to gap up or down depending on the volume, depending on the size trading, depending on the aggression. So that's why we do not use pre-market or after hours on stocks. I don't really care what happens overnight. On the overnight session with stocks because of the low liquidity issue, and it's very easy to manipulate a gap up or down depending on the catalyst. And it basically leaves an order imbalance overnight. That's why we have a thing called the gap fill. So if you ever see anybody talk about, this gap is going to fill, we're going to fill this gap, that's my target. It's because it leaves an imbalance, and basically the imbalance is the gap up or down, where not a lot of market participants can trade that because not a lot of people trade in the overnight session for certain stocks. So that's why I don't really consider it a strong zone, a strong area of interest, since not all market participants are participating in that gap up or down because it is very easy manipulated. It's very easy to manipulate that move accordingly. So here we have Nvidia on a 3-hour chart, 3-hour supply zone, which is formed off of a gap down. We had a rally here, then we based out where my cursor's at, and then the next candle was a drop, but it really wasn't a crazy drop that would have left a crazy order imbalance. What really interested me was this gap down, and we gapped down, from 366, we gapped down like 8 points or 7 points. So that was a strong gap down. Definitely would have left some orders here, some buyers stuck from this gap down. So I extended that price all the way to the current day. And then if you go to a smaller time frame, we rejected it pretty perfectly. And what I like about this trade is that we broke above the supply zone. We rejected it here, and then we came up, we broke the high, and then we failed to maintain above the high. Didn't really attract any new buying. These were weak buyers up here. Now we have more trapped buyers buying a high day break inside of a supply zone. And then that's why you get this nice pullback and this profit taking, which would give us a nice dump to the downside. So that was based off of a 3-hour gap down supply. And the reason why we have a gap down is obviously because of an order imbalance, a liquidity issue, which led to the gap down to begin with. But like I said, I don't really focus on gaps. I don't really care about them that much. Yes, sometimes they'll produce, good setups, especially like this. So it's important to just, chart them out and mark them as gaps, because I could look on a chart and find tons of them. So, I could look, right here, we had a basing period followed by a gap up. And then this zone, if you're taking this trade, it came below the zone, probably wouldn't have taken that trade. I could look through these charts all day long. Here we had another gap, and price, never came into this gap down. So we dropped, based out, and we rallied from a gap up. This is technically gap up demand, but, price never reached it. Same thing with this. We based out before the close here. We gapped up. This technically is gap up demand, but look what happened when price reached it. We completely ignored it, completely invalidated it, probably right at the open. Keep going. This was another one. So this is a perfect example showing you how sometimes it works, sometimes it doesn't work. The key is finding, imbalances that form on a daily basis. That's why I don't really pay attention too much to these gaps. So here we had a drop, a base. Let me see if I could make this better. A drop, a base right before the close, followed by a gap down, which really technically constitutes as a gap down supply. So fast forward to price, see what happens. Price then comes into the zone, trades pretty much near the top, and we do reject that zone. So it's really 50-50. They're not the highest quality of trades. If I had to give you one piece of advice, I would just focus on intraday zones. Don't really care about gap ups, gap downs, for those reasons mentioned. So here's another example on Netflix. Let's see if I can make this bigger for you. We had a drop here on July 29th, followed by the next 4-hour period, which was a basing period before the close. Then the next day we gapped down, and after the gap down, we followed through to the downside, which really validated a drop, a base, and another drop. So technically, you could consider this 4-hour supply. Now, if you go to an intraday chart, you could see, let's see this 4-hour supply, give us a nice, this is a 15-minute chart, a nice push up into supply, rejected it pretty much to the penny, and then sold off. So this is based off of a 4-hour drop, base, drop, and that second drop was based off of a gap down. And another thing I'd like to note is that usually you find basing candles before the close on a daily basis. 8 out of 10 times you usually will. That's because, the markets usually, before it closes on the stocks that we do trade, usually are quiet. There's no crazy price moves up or down. Yes, there's some occasions where that may be the case, But for this example, we Facebook right here before the close. If you were to completely ignore these two candles right here, this technically is a basing candle, and we gapped up. So that's technically demand. Would I consider that demand? No. It's just the gap up. We didn't really have a strong push to the upside. It's just not as high quality. It's just not as high quality as I would like to see it. Same thing with down here where my cursor's at here. This technically is a basing candle, and we had a strong gap up on earnings. So that technically is a demand zone. We had a basing candle before the close, and we gapped up. And another thing I'd like to mention is that sometimes the opposite may happen. So we gapped up here, but as soon as we gapped up, we created a supply zone. And then look what happens. We gap up, we basically rally, then we base out right here, and then drop. So technically, you get a rally base drop from a gap up, and that first rally could be from that gap up. You extend price, and 5 days, 6 days later, we hit that rally base drop pretty perfectly, and this would give us a nice short entry from there. So it's also on the opposite side too. Rallies or gap ups can produce supply, and gap downs can produce demand. So like I said, just focus on intraday zones. Mark these zones out, but really do not give them strong interest. Don't really take high trades off of them, large position sizes. Just keep this in mind, and then you'll see what I mean as you chart out and as you get more examples going and start seeing and recognizing these zones in real time.